Yo, what up, everyone? In this re-upload, I want to talk about how to day trade for a living if you treat it like a business. We all know you can make a crap ton of money anywhere you have internet, and you can make this your full-time job and trade for a living. But first, we have to relate it because this is very relatable to many things in life. So if we want to make money doing this, we want to be profitable, we have to treat our trading like any other profitable business. This video is going to be inspired by Jesse Livermore. We're going to get into a bunch of charts and a bunch of examples. But before we get into that, if you want a very good trading resource, I'm going to link my Instagram in the description below at Investitrade. I post daily trading recaps on here, along with very good trading tips and tricks that I guarantee you're not going to find anywhere else. Link is in the description below. I definitely recommend following it. But now let's get right into the video. Point number one is you can't open up a business until you have a full detailed plan, whether it be something ingrained in your head, written down on a piece of paper. A business plan is very important. It tells you everything you need to get done to accomplish whatever your plan was trying to achieve. Same thing with trading. Our plan has to deal with our strategy, our entry and exit points, market context, how to handle our emotions. We're going to break all of these down in this video, but that will give us our edge over the competition in trading. Same thing with businesses. You have to have an edge over other businesses, something that others don't offer, something that others don't do. It's going to be very hard for a pizzeria that is not successful to open up next to another pizzeria that is successful because you have no edge in that. You're doing something that someone else is doing and you're not seeing any success in it. So you have to find your edge. You get this by having a solid strategy that's been tested, valid entry and exit points for you to understand context and for you to control your emotions. So point number two is your customers are the ones you sell goods to and buy goods from to increase profits. You have to outsmart the competition. So think about this. Think about you have ingredients for a pizza. You want to buy those ingredients at wholesale prices. You want to make that pizza cost you as little as possible. And then you want to sell that slice of pizza or that pie at retail price to those consumers that are looking to buy your good. So buy at wholesale and sell at retail. The same thing is with trading. So this goes into our first point about having a fully detailed plan with a strategy. My strategy is supply and demand. So the idea here is we look to buy at wholesale prices where things are basically on a discount, and we could find these at supply and demand zones. Demand are wholesale prices where we look to long the market, buy shares, long calls. And supply is where we look to sell our original good. In this case, we're our shares, our option, whatever instrument we're trading. We want to sell and look to take profit at supply. Same thing for downtrends. We want to look to sell the market first at a retail price, and retail is at supply. And we want to look to buy back at wholesale price at a cheaper if we were looking to open up a bearish position. So demand is a wholesale, retail is supply. These are our valid entry and exit points, and this is my detailed plan with my strategy. Point number three is something that I wish I had when I first started trading. You must have partners or like-minded people to talk to, a community where you can learn from others who have been in the business, who have had success, and you can learn from their past failures, their past mistakes, and it'll help you maybe not make those same mistakes that you were taught from those people that have had skin in the game for a while. Think about, opening up a pizzeria again. If you can open up a pizzeria by yourself. You could do it all by yourself, have no help, but you would learn more. You would learn the ropes a little faster and better by learning from someone that has been in the pizza game for maybe 50 years and has run a successful business. So you have to look at it as an investment, something you do now. It's an opportunity cost. It might prevent you from taking unnecessary losses sometime in the future, where maybe those losses will put you out of business and you can't continue going forward. So I created a very active and engaging community of like-minded traders. Everyone in here is looking and striving to help one another out. We post pre-market plans, we post intraday commentary, and we occasionally do webinars. So whether it be mine or a different community, I definitely would recommend joining one. It'll definitely help propel you forward. Your mind is the manager of the business. You can't let emotions get in front of everyday decision making. The two most deadliest emotions are fear and greed. These will make a business fail. If you let these fear and greed make the decisions instead of factual pieces of information, It's a big red flag for a business, a failing one. Same thing with trading. If you trade off of intuition, what you are feeling, instead of factual pieces of information, more likely than not, you are going to take losing trades because that's just not how the market works. So how we can relate this to trading is there's fearful trading, and I have a video on this as well. Let's say we were looking to long the market, buy it down here at demand, and the market starts immediately ripping up, and we're in profit right now. But we're so fearful that this market's going to come down. As soon as we see a red candle like this one right here, what happens? We panic out of fear. Our emotions, our decision making was in result of what we were feeling. We were fearful, and maybe we sold for a $50 winner instead of, if we followed the plan, a $200 winner if we just sold at supply. Same thing for the greedy side. Let's say we were shorting the market up here at supply. We were buying, opening up a bearish position, shorting the market here. We come down immediately, but we're too greedy. We want to squeeze every penny out. We think this is going to continue heading lower, so we don't sell here. Instead, the market comes up here, and what happens when it comes up here? We start panicking, we're fearful, and what was a $100 winner down here might now only be a $20 winner over here. So these emotions should not influence your decisions. Your entry, your exit points, your strategy should all be planned out. Therefore, your decisions are not made based off of your mind. They are made off of factual pieces of info. With any business, having insurance is going to help you manage risk. Unnecessary things that could go wrong with your business. By having insurance, it's going to protect you a little bit. Now with trading, what's going to protect us is something called stop losses. So these stop losses must be implemented to prevent incurring preventable unexpected losses. So going back to the SPY chart, pull it up here. A stop loss, whether it be mental stop loss, meaning if a stock goes above or below a specific level, I'm going to exit for a loss, or a hard stop loss where you physically put an order at a level to stop you out. So in this case, let's say we shorted SPY up here at supply, and we're coming down, and in this case, our stop loss is above the high of day. Now, every plan, every trader, every strategy is going to have different variables. They're going to have different avenues. If you think about it, a business has tons of different avenues to become successful. Same thing with trading. So it's not a one size fits all. Different traders have different risk tolerance. Businesses have different strategies. So in this case, an acceptable stop loss is either high a day or above the supply zone at 368. But just for this example, let's say our stop loss is at high a day. If we implemented a stop loss and the stock does reverse on us, like it does here, we would be out of the trade because it came above our stop loss, and it would prevent us. What's stopping this from coming higher and higher, and from this thing ripping, all the way up another $1, $2? We don't know what's going to happen in the market. So us as traders, we have to manage our risk properly, and you do so by using a stop loss. And in this case, we kept continuing higher, looked very bullish. We would have been in a lot of pain up here if we did not stop out where we originally looked. And again, this thing did come down. So this is where trading becomes a little tricky with different variables, because a trader that had a stop loss above the high up here would not have got stopped out versus someone that had a little smaller of a risk tolerance above this high. So it's all about position sizing and stuff like that, which will be good for stop losses. But stop losses will definitely help manage risk, and it'll help prevent taking unexpected losses that could be small in the beginning, but if you don't have a stop loss, they could be much larger. This is a good one. Your positions are your employees. You want to keep the good employees and get rid of the ones that lose you the most money. So if you have a business and you have an employee that's showing up always early, on time, respectable to customers, always going the extra mile to make your business a little more successful, then you obviously want to keep those. The employees that are showing up late, that are miserable to your job, scaring customers away, obviously you want to get rid of those ones. Trading, it's the same thing. Your goal as a trader is to have a trading journal, see what works for you, what are the good trades you take, get the variables that make them all comparable and similar, and then grow on those. And then the trades that you lose the most on, you don't feel confident in, you don't feel comfortable taking, the ones you lose the most on, the ones maybe that mess you up the most psychologically. Get rid of those trades, find the common denominator, and completely nix them from your trading. Point number 7 is expansion of the business only can happen after your first endeavor is successful. This is another very crucial point because I see traders, they try millions of different strategies. They think this one's going to work, that one's going to work. They search for a holy grail, something that works 100% of the time. And more often than not, those traders are the ones that the first people to blow up their accounts. You have to master one thing at a time. Any strategy is going to be profitable. It's you that makes it complicated. It's you that incurs those losses. So focus on one side of the business and then grow from it. Maybe start with small size. Trading is very, very scalable. That's the beauty to it. If you can make a lot of money, if you can make money with a little money, then nothing's stopping you from making a lot of money with putting more money in, increasing your position size, putting a little more risk on the table. If you want to expand your pizzeria, you started off just as a takeout, you walk in, you grab a slice and you leave. That business took off, people love your pizza, and now what do you want to do? You raised up more capital from selling, the first part of that business. Now you want to open up a dining room, you want to have a sit-down restaurant type of business where people could sit down and order from a full menu. That's the expansion of the business, and it could only happen after your first endeavor is proven successful. Same thing with trading. Once you master a strategy, once you feel confident and comfortable with it, then your goal is to scale it up, increase your position size, and in result, your wins are going to be much larger. And the last point is your trading capital is your inventory. If you lose your inventory, you're going to lose the business. I preach this all the time. I am very conservative in my trading. I focus on defense over offense. There's no reason to try to hit a home run. The more times you swing for it, the greater the chance of striking out. I want you to look as your trading capital as your inventory. If you lose the cash in your account, you completely lose the business. There's nothing you could do. You can't put trades on. It's the same thing with a business. Your inventory should be like your baby. Preserve it more than you want to grow it, because if you preserve it, it's going to naturally grow. It's just the natural cycles of life, and it's the natural cycles of business. I'm going to end this video on that note. If you enjoyed it, drop a like, comment if you have any questions, and if you truly want to learn more, check out the links in the description below. I offer a very in-depth and educational course that will come with access to the Discord at no extra cost. But besides that, I'm ending it. Peace out.